Good afternoon, everyone. This is James coming to you from Dividend Stock Talk. Today is Friday, August 4th. It is 3:35 p.m. I need to apologize first for being a little bit late. I was out at the senior center with my dad. He was playing some live music. Yes, my dad is still alive and he still plays live music. It's kind of funny because I'm the youngest one there. I'm in my 50s and my dad's in his 80s. Oh, getting to be in his 80s. Playing live music, some rock and roll and some old country and western. It was kind of fun. Anyway, let's get back on track. Dividend Stock Talk. We are here to talk about dividend stocks that are going to give us dividend checks. Because, hey, everybody likes a dividend check, you know? And our philosophy is collect as many as you can. Why not? Buy the stock at the right time, eligible for the dividend, and collect the dividend, turn around and resell the stock for a small profit. Move on to the next company. There's no law saying you have to hold the stock all year long in order to get a dividend check from the company. No, no, no. You just have to own it 2-3 days, tops. You buy it before the date of record. Well, you buy it before the EX date. The EX date represents the last day the stock changes. Sorry, the last day the stock trades before the dividend is paid out. After the EX date, it's usually 2 days or 3 days, is called the date of record. That means you will become the registered owner of that stock, thus becoming eligible for a dividend check. How many do you need to get in order to reach your goals? Totally up to you. But if you think about it, if you buy a stock on Monday, the EX date's on Monday, or I should say, got this right here on Tuesday. On Tuesday the 1st, you have to hold it at least 2 days. The date of record, which would be the 3rd. Okay? Then you can turn around and sell it on the 3rd or the 4th. Let's say you sell it on the 4th. Then your funds are all free for Monday. You do it all over again. Buy a stock, 2 days, collect a dividend, sell it that day. Do it again, do it again, do it again, do it again. You should be able to, if done properly, 10 to 20 checks per month collecting dividends, 10 to 20 of them. You should be able to. Because you don't take all your money and put it into one stock. No. You take all your money, you divide it up into a manageable number. Some people do 5 trades, some people do 8, some people do 10. If you want to do 10 trades, that means you buy 10 different companies the first week of August. Okay, the 31st, 1st, 2nd, 3rd, 4th, 5th. So you get 10 different companies. So you buy one here, one there, one there, one there, one there. Okay? Or 10 different companies, 2 companies, 2 companies, 2 companies, whatever. But the first one is going to overlap the 4th and 5th. Okay, so you're buying the first one on a Monday. You collect the dividend. You won't be able to collect it until the date of record, which is 2 days later, which would be the 2nd in this example. Then you are eligible to collect it. So then you can turn around and sell it for a little bit more than you paid for it. So now you're at Thursday. And then you buy another 2. And then so on and so forth. So if you have it staggered properly, you buy, however you want to diverse your money, because you don't want all of it in the same basket. So let's just say 5 different strategies. 5 different companies. So that means 20% would go into one company, 20% into another, 20% into another. So you're only investing 20% of your money into each company. So if you have $100,000, let's say hypothetically, then you put $20,000 into each company. Thus, have your $100,000. Now, if you only had $10,000, then I would suggest you only do 2 companies, because you have to have enough shares to make it worth your while. Because if you only trade in 2 or 3 shares, the commissions are not going to offset the amount of money you're bringing in. Because let's face it, dividends are usually between 10 cents to $1.50. And they could be anywhere from 10 cents to $1.50. It could be 30 cents, 40 cents, 78 cents, 72 cents, 64 cents, anything the company wants. So you got to put a little bit of creative math into it. Now, the company that we use to do our trading on is Thinkorswim, all right, TOS for short. They charge me $5 per trade. So that's $5 in, $5 out. That's $10 each time I buy one and sell one. So I have to make sure that the amount of shares that I buy, first of all, are going to cover the $10 in commissions. Okay, at 10 cents, that's 100 shares just to cover the commissions. Now, to make it profitable, I got to do at least 200 to 1,000 shares minimum, just to make it profitable, to cover the cost of the commissions and to make a profit. Because it has to be profitable. If it's not profitable, what's the sense of doing it? Now, I understand you might want to, start out small and do a few shares here and a few shares there. Great. But you got to make sure you do enough shares in order to make it profitable. Plain and simple. It's 3:40. Let's stop wasting time and see what we're doing. Because this week was a little strange. I didn't get to make any plays this week because we bought Colgate-Palmolive at the beginning of July. Don't get me wrong, we traded every week with them, which means we did a covered call. We owned the shares, 5,000 shares. So what we did is every week that we've owned them, we sold a weekly option for somebody else to buy it from us. The first week was great. We got 2,600. Second week, we only got 22. Third week was 21. Fourth week was like, I think, 1,200. And this week, which will be the fifth week we got it, we didn't sell any options against it because it just wasn't worth our time and effort. So let's jump in and see where we are. Okay. Get out of there. Let's go to monitor. As you can see, Colgate-Palmolive. Let's put it into the excuse me, I don't know where that's coming from. CL. Trading down again. What is it with Colgate-Palmolive? She starts the year off the 74 area, drops, trades for a month and a half at 74, drops down to the 72, 73 area, trades there for a couple of months, drops all the way down to the 60, 64, 67 area, trades about 3 or 4 months there. Then middle of February, she jumps from 67 back up to the 73, 74 area, goes sideways, hitting a high of 77 and a low of 70, 69, 70, somewhere in that area. But for the last couple of weeks, she's been having nothing but down, crappy days. What is it with that? Down, 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 down. Now, we did make money during the, what do you call it? The EX date. And we actually, I forgot all about that. We actually collected, I think it was like 50 cents per share for the dividends. So while we're collecting premiums for the covered calls, we also collected, I think it was like 2,500 just in the dividends, which was kind of cool. I like that. So we profited quite a bit from Colgate-Palmolive the past couple of weeks. We're just not doing squat today. But for the fun of it, let's see what we can sell for next week. All right. No value there today. Let's go 7 days. What is 7 days going to give me for 74? Back up to the spreads. Make sure we're doing the single. Single 74, 5 cents a share. Arrgh. See, that's the part where it's just not good enough. You know, like don't get me wrong. That's 250 bucks. Do I really want to do that? I don't know. Let's see what the seasonality looks like. Seasonality for Colgate-Palmolive. Here we are. All right, here she is now. She should have some little tweak between today and Monday, because tomorrow, which is the next trading day, Monday, should be a little tweak on the upside for tomorrow, and then she'll be going sideways for another week before she drops. I'd really like to be out this upcoming week, and I really don't want to sell for a loss. So let's see what we can do with Colgate-Palmolive. Other than that, I think I gave some tips this week. CTSH. No, we didn't do CTSH that much. I do know because the numbers didn't look good. We did do Visa. Because Visa looked good. Let's get back to the standard chart, see what that looks like. Okay. Alright, so had you gotten in on Monday, because this list comes to you on Monday morning at 6 a.m. Had you gotten in on Monday, Visa would have done good for you. Okay, she opened up on Monday at 99.50. She hit a high during the week. Was that 101? 101.34. So you would have hit the target for that. That would have been good. Let's get out of there. That splits. Oh yeah. No. Who's doing splits this week? No one. No one's doing a split this week. Oh yeah. 2 companies doing a split this week. Oh, 1 to 4. That's a reverse split. You get 1 share for every 4 you get. Who wants to do that? Just for the fun of it, let's just take a look. RMGN. And that is Networks RMG Networks Holding Corporation. Oh, there you go. No wonder why. She starts off the year at $1.02, $1.03. She drops on down. I mean, she's just sinking down to a 69-cent area. She trades that way for a while. And then the middle of February, for some strange reason, she goes from 73, hits a high of 110. 73 to 110. That's a 40-cent raise, which is over 50% increase. Okay, once she hits that, slowly goes downward. So that's where she is now. She's at 55 cents. Now, what is the reasoning for this thing to go down? Now, yesterday she had a crappy day. Okay, it was a down day. She opened up at 64, and she hit a low of 54. And there was quite a bit of volume that also increased in that one too. But anyway, I really don't like reverse splits because they're not. Ooh, here you go. TAL 6 to 1. And that's happening in 4 days. That's on Tuesday. What's TAL doing? TAL. Oh, it's 160 bucks. All righty then. I love that one. Okay, she starts out the year at 58. Youch. Now this is a good one. I mean, it starts the year at 58, goes sideways for a couple of weeks, slowly increases to hit a small high of 82, which is close to a 50% raise. A little bit of profit taking. Finds a new at 67. Then from 67 in late December, it's almost a continuous upturn. So she hits a trading range of 100% increase in 5 months. So she basically doubled in 5 months. She hits a 126 trading range, and she trades there for like 2 or 3 months. Then, the beginning of July, she's at 123. And from 123, over the next few weeks, she goes from 123 to 160, which is where she is now. So Tuesday, they have a split coming up. And it's a 6 to 1 split. It's an awesome split. So let's see if they even have any options available. And they do. Awesome. So you got the August 18th. Now, with a 6 to 1 split, what can you possibly do? All right, let's check out a spread. Okay, the vertical spread. She's at 160 now. So 155, 160, 310. Oh yeah, check that out. at 310. 19. Ooh, that is more than a 50%. Now that is pretty awesome if you think about it. Now, granted, this doesn't have anything to do with dividends. I'm just, for the fun of it, poking around because I didn't really make any plays this week, so I really can't give you any advice on what's what. But anyway, TAL Education Group. Don't know what they do. Isn't that sad? Here I am looking at trying to invest in them. I have no idea what they do. Okay, so they're on a breakaway. They've almost tripled their money in a year. Okay, so she's back in the 50s at the beginning of the year, a year ago. Now she's at 160, which is 3 times in less than a year, which is great. So here we have a 6-to-1 stock split. What usually happens in a 6-to-1 stock split? Stocks usually have a tendency to go up. Now, when did they announce that stock split? So let's go back here for a second. Okay, so the end of July, they made the stock split announcement. Which was the 27th. Where's the 27th? Right here on a down day. So, all right, so they had a down day. She opens up. Now, was it an early morning announcement or a late in the afternoon announcement? Okay, so if it was a late in the afternoon announcement on the 27th, then the market would have closed and they would have opened up on the news the next day, which would have been here. So she's been going up from 150 to 160. It was a $10 move in the last week. Can she continue making it? I don't know. But a 6-to-1 split, it's a nice move if you ask me. Okay, so if we do this trade that we're talking about, because she's at 160.74 now. If you do the 155, 160 for $3.10, you're going to make, you're going to basically double your money. So you're making a 50% increase on your money. So you put up $1, you get $1.50 back. That's pretty damn good if you ask me. In this instance, you're putting up $3 and you're getting $5 back. I don't know, but you're making over 50% return on your money for what's that? Is that like 7 days? I think. Oh, it's 14 days. That's for 2 weeks. So that's not bad. That's like 25% a week. I can live with it. But that's playing the splits. But before you do that, let's take a look at what the seasonality looks on this, because you don't want to be buying something that's going to go the wrong way on you. And wow, doesn't that look sweet? Start at the beginning of the year, and it's nothing. It is no I'm trying to think of the right word. I want to say scraggly, but no. There's no huge up and down movements. There's no all over the place. That looks pretty much a nice move from what do you get? 22 to 36. So that's almost a 50% increase from the beginning of the year to the end of the year. And this is 10 years worth of data, 1 year after another, after another, after another. So that's pretty damn great. I mean, here's where we are right now. And this is what you're going into. Basically, almost a flat market. Okay? Right there. And that line, it's going up, but it's going up a tiny bit. So what do you want? You want to do a trade that you're going to make money if the stock stays the same, or the stock goes up, or the stock doesn't move at all. That's what we're looking at. This trade right here, the 155, 160, which expires in 2 weeks, is going to cost you $3.10 for every $5 bill that you want. Okay, you want one $5 bill, put up $3.10. It's not that bad. It's over a 50% increase in return on your money. So, seasonally speaking, or seasonality-wise, the 10 years worth of data tells you this is going to slowly creep up, which is great. So you're always going to have a nice little return. And the nice thing about this trade is as long as the stock stays, let me go back right here to the chart. Okay, here we are right now, 160.76. Okay, you get this 6-to-1 stock split coming up. I mean, a lot of people are going to get into it just because they have that stock split. It may be a great company. I honestly don't know. But statistically speaking, people like stock splits because it's one of those indicators that has a let's say a bull type atmosphere around it, because number one, they wouldn't be splitting unless there wasn't a lot of interest in the company. So there's a lot of interest in the company. This particular play, okay, for the next 2 weeks, as long as the company stays above 160, that means if the stock goes up, you make money. Stock stays the same, meaning it doesn't move at all, just stays right where it is, you make money. And the stock at this point in time can even go down and you're still going to make the money. It's a lovely play. That's why I love these plays. Granted, you're not going to make a huge amount of money. See, look. All right, let's get out of there. If I bought 50 contracts, that's what I like to do. I like to buy 50 because it's usually easy. But this one, it might not be because this is a $5 spread. Okay? Buy the 155 and sell the 160. The difference between the two is $5. How much is it costing me for each one? $3.10. So how much can I make off of this? Well, let's find out. All right, the maximum I can make is $9,500. How much is it going to cost me? $15,581. What has to happen? The stock's going to stay right where it is, basically go nowhere. If she goes up, I make, and that, my friends, is more than 50%, because 9,500 is more than half of 15,000. Okay, so if you actually double this, that's 19,000. That's way up there. You want to know? All right, fine. You want to know the exact number? Here we go. Let's get to my calculator. All right, here's my trusty old calculator. And we're looking at 15,581. 9,500 divide $15,581. Okay, that's what's going to. $15,581. Right, roughly, not exact. All right, check that out. Almost 61%. You make a 61% return in the next 2 weeks. And it looks like a very good trade. So let's get back to where it was, right there. All right, so as long as the stock stays above 160, okay, look, now it's almost at 161. And if I don't make this trade soon, I'm going to lose the opportunity to do so, because the number's always changing. So what is it at now? It's at 310, whatever. All right, so that's just that one trade. So it is 2 minutes of 4 o'clock. The market's just about to close. I don't have diddly squat to show you, so there's really nothing for me to do. Hey, check it out. Sherwin-Williams closed out. Okay, so I made $900 on that account today. All right, DFS went up $400 today. Macy's went down again. SKT went up. All right, but they're still down. All right, so I got those 3 positions that are down. Now, this is the second account. Okay, remember, we got a bunch of different accounts. We have a bunch of different trading strategies. And each trading strategy has a different risk factor. Now, this trading strategy here has very minimal, almost no risk whatsoever. You buy the stock, you own it so that you collect the dividend every 90 days. Okay, we've already collected the dividend twice on Macy's, and we actually is getting ready to come up for a third time to collect on Macy's, which is always good. As I was saying, it's a relatively very safe strategy. You're buying very good quality companies, and you're collecting the dividends on them, and you're trying to sell it for a little bit more than you paid for. This is what we call our dividend on steroids. Because do I really want to collect the dividend? No, I want to collect the run up into the dividend. What does that mean specifically? Okay, I'll give you for instance. If Macy's is paying out a dividend, let's go my watch, on the, let's say the 18th, because that's highlighted already. I want to buy the stock 10 trading days prior to that date, which would be right here on the 4th. Okay, that's 1, 2, 3, 4, 5, 6, 7, 8, 9, and 10. 10 trading days, which would be the 4th. Now, I'd put my order. Oh, give me a heart attack when the bell goes off, right, ringing in my ears. Hate that. Anyway, where was I? Now I'm lost. Anyway, the market just closed. And I forget the point that I was trying to make. Imagine that. Oh, okay, so we want to get the stock 10 days prior to. So I put the order in the night before the 10th day. So the 10th day is right here on the 4th. So I put my order in on the 3rd after market. Okay, so that means first thing on Friday morning, right here, the 4th, I would have opened to buy that stock. Okay. Now it's 10 days before the EX date, and I'm only looking for a 2.5% increase in the stock price, which means, who am I looking at? I forget who I was looking at. I was looking at Macy's, wasn't I? Okay. Okay, Macy's at 23.36. So if I bought it at 23.36, let's clear all that. 23.36. Now my target price would be the purchase price plus 2.5%. So I multiply that by 1.025. What that is going to give me, that's going to give me my target price. Because any number, this number here, 23.36, multiplied by 1 by itself is going to give you that exact same number. And 0.025 is 2.5% increase. Okay, so my new target would be 23.94. All right. So if the stock hits 23.94, I'm automatically out within that 10-day time frame. If it doesn't hit it within that time frame, let's go back to where we were. If it doesn't hit it within that time frame, then excuse me, I collect the dividend, and then I turn around and I resell it for the exact same price I bought it for, just a tiny bit more than what I bought it for, to cover the commissions and any other costs, so that I still get my profit and I still get out, and it's still a good company. So all that being said, the market's closed. There's really nothing we can do until this weekend, where we're going to go jump in again and take a look at what's going on. There's nothing really left for me to say, so I'm going to check and see if there's any questions. No questions. All right, you guys, you got to come up with some questions. You know, I feel like I'm just talking to myself. Anyway, back where we were. That being said, if I don't collect the 2.5%, like I said, I collect the dividend, and I turn around and I recalibrate my sales order to sell it for 1 or 2 cents more than what I paid for it. All right, so if I got 1,000 shares, you're looking at $23,000. All right, and if I'm buying it at 23.35, this is where it is now, I look for the 2.5%, which just so happens to be 23.94. If the stock hits that price, great. If not, oh well. I collect the dividend and I turn around and sell it for 23.35 or 23.36. That way, I collected the dividend and I'm selling it for a small profit. Granted, it's not a huge profit, but it's a small profit. If you want to do a sales order with a trailing stop, so that the stock price just keeps going